Today, folks, we're talking about the best Canadian dividend stocks of all time and why you need to own them. From a comment from Mr. Gregory6768 saying, I love this channel, but also feel that investing in individual dividend stocks like TD or Enbridge is great too. I sometimes feel the ETFs are the new mutual funds. So much hype, perhaps going back to the basics has some meaning, and that's what we're going to do in this video. But you have to understand, like Pokemon cards, I believe you need to collect all the Canadian banks, but I also love Enbridge and Canadian Natural Resources. However, I think the telecom giants are trading at massive discounts and are starting to prove some value, but you have to kind of pick and judge the ebb and flow of these sectors, whereas a market cap weighted ETF like VDY till I motherfucking die, my favorite monthly paying Canadian dividend ETF, market cap weights all of these, giving me the ones that I would rather upper weight at the top of the ETF. For every $1 I put in VDY, 30 cents of it, 30% of it is going to Royal Bank, TD, and Enbridge, and I sleep very easy at night knowing that if these start to underperform, they will slowly de-weight their way down, but it is heavily concentrated, and that's how I like to personally invest. But if you want to hand select some of these, by all means, and we're going to talk about the hand selection of what I believe today is one of the best, most underrated Canadian dividend stocks of all time, and then we'll talk about the banks, the telecoms, but I'm really going to dive into Enbridge here. I think Enbridge is one of the most underappreciated Canadian stocks. I think it's competing with Tesla. I think it's having a whole new growth phase that people just aren't talking about. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey. Hit that subscribe button, folks, because Enbridge, man, over the last 5 years, up 54% just in equity. If you've been buying the dips, you've locked in a 6 to 8% yield. Your rate of return has been absolutely astonishing. But this company is the lifeblood of North America. It's the largest pipeline company, one of them globally, with pipelines stretching from northern Canada all the way down to Mexico. Liquid pipelines for oil you see in the purple lines, the blue lines for natural gas, all over the Western world here. You've got LNG facilities and storage for the oil and gas distribution. If you go out and you live in Toronto and you see the natural gas coming into your house, it's very likely that's coming from Enbridge. But we need to talk about the renewable space because that's where Tesla said they're the leader in. They're building their storage with batteries, they have solar, and yet all these mega cap companies are actually turning to Enbridge and not Tesla for these mega projects. In fact, Enbridge is helping power Meta's data centers by building and investing a new large-scale solar project. This is not small scale. This is in $900 million, $9 billion construction of a 600 megawatt Clear Fork solar plant near San Antonio, Texas. This is going to come under in service by 2027, and Meta's not the only company doing this. Amazon's doing it, Toyota's doing it. These are all companies partnering with Enbridge. Now, the only downfall and thing I don't like about Enbridge stock itself is the dividend growth rate has slowed materially. We're talking about 5-year growth rate of 3.39%, where comparably, if you just buy the basket of the best Canadian dividend stocks, like with VDY, you're getting about an 8% growth rate. But again, you're not getting that higher starting yield. However, Enbridge starting yield today is around 5.65%. That does not entice me to really want to start loading the boat on Enbridge here, because comparably, this is a stock I've told you guys you want to catch on dips because you're really looking to get your full rate of return from the dividend, and any equity growth is a cherry on top of the cake. And now that we're kind of down to this 5% yield, it's kind of more in line with the 2020 or 2018 era of dividend, whereas if you bought those dips, like I said, you could have seen anywhere from a 6 to 8% yield, and that's kind of what you want to lock in here. But if we take a look, there's some new growth phase going on here. We know that Enbridge purchased a huge natural gas provider in the US, but that has led their assets going from 168 billion to 218 billion. And we also have the double-edged sword of interest rate cuts that are about to happen in the US. They've already happened in Canada, and this is a large infrastructure company with 150 billion in liabilities. So that's going to help alleviate some of the debt and financing costs that should start adding some more earnings per share to the bottom line, which we're starting to already see actualize. But year to date, they're generating 10.4 billion versus this time last year in 2024 where it was 9.2 billion. This company is in a new growth cycle, and it is still so largely underappreciated in the Canadian economy and in just investors at large. I'm shocked at how few people talk about this stock, considering you can buy it in the US and in Canada. So I'm very happy that it's one of the largest positions in my portfolio, just thanks to VDY. But if we just see the hidden value in this Canadian giant, I've been noticing some people have been pointing out that these massive, new facilities that they're investing in, but there's more to come, obviously, as these projects are not small side bets. The current secured backlog stands at over 30 billion, spanning growth in every business line, and management has identified a 50 billion longer term opportunity set that's supported by 9 to 10 billion in annual investment capacity. Even after factoring in regular dividend increases, those dividends remain one of the company's biggest selling points. A forward yield near 5.8 with a history of annual raises. While the payout ratio is above 100% on reported earnings might look stretched, the calculations based on the distributable cash flow paints a much more sustainable picture, because infrastructure companies have depreciation and amortization. I hate when people say they can't afford the dividend. It's just because, guys, it's like buying a car. You're going to pay that payment up front. It's going to maybe look like a liability on the balance sheet, but every year that car is depreciating in value, but it's still producing the same cash flow. I can write off the depreciation against the cash flow that it is still producing, and that cash flow doesn't show up on the earnings per share. Yet if I'm paying out a dividend from that cash flow, you only see the dividend that's being paid out versus the earnings, not the actual cash flow minus the it's a taxable thing, right? That, if you're an accounting nerd, you'll understand it quite clearly. So you can sleep comfortably at night knowing the dividend is not going to go anywhere, knowing this company is powering the entire Western world. Now, taking a look at the banks themselves, guys, I do have some concerns here, and it's going to be neat to see if earnings can alleviate some of my concerns. And I said the same thing about mega tech companies. I was very concerned about valuations, but when earnings come around, I have to look at the facts. And the facts are companies are expensive, but their earnings are exceptional right now. And when it comes to the Canadian banks, we need some exceptionalism here because they ain't cheap anymore. TD, after coming out of that massive scandal, money laundering fines, asset capping in the United States, the stock is starting to re-peak all-time highs here, giving up that awesome dividend. And again, congrats to anybody that bought the major dips. But we also have Royal Bank still touting all-time highs, now trading at the highest valuation it's ever traded at in its entire history. And I've told you, you can really trade these mega cap companies off their dividends, because when the dividends become less expensive, you don't want to be buying them. And when the dividend when the dividend yield gets higher, that's when you want to buy it. And there's been a few peaks over the year where we've seen 5% yields off of, TD and Royal Bank. And that's where you really wanted to be buying them, because right now the dividend yield is lower than it's been since going all the way back to 2007. And that does not get me excited as an investor. TD is kind of around this 3-4% right now. But again, it's peaked over 5% a couple times as of recently. And those are the moments, if you're looking to buy these individually, where you really want to capture them. And I really feel like dividends could be a defining factor to when you buy these kind of stocks. Even now, I would be more intrigued over the banks buying the telecom giants. And I've told you, we've bottomed. I'm very comfortable that we've bottomed, and we're now back into a new growth phase after the restructuring. The lower interest environment is here, and we're seeing a year-to-date return of 18% so far on Telus. It's now hitting a new yearly high. Still, the dividend yield is at an exceptional place of 7%. You could lock that in with Telus, and you basically just get your full rate of return from the dividend and be comfortable knowing when the equity recovers, it's a cherry on top of the cake. Now, it is a hard thing to stomach, knowing that the stock wiped out years of gains. But again, if you are an income-oriented investor, this is where I would be hyper-focused right now, because this is a very underappreciated sector right now that is severely depressed. But again, you can't be looking at equity as the defining factor to a dividend portfolio, because if you are, I would still recommend buying something like VDY or the ETFs for that total return. But I understand people in retirement, some people are just dividend focused, and I don't think there's anything wrong with that if you do it correctly. But look at the telecom space. I mean, Bell's recovering now, up 7% year to date. Rogers is up a whopping 13%. I don't think you can do wrong right now looking at this sector as a whole, but you have to recognize when you buy these individually, you're going to be playing this ebb and flow game where you have to go back to what basically, Mr. Gregory mentioned here is the fundamentals. Like, you can't just be blindly buying these and cost averaging across 20 or 30 stocks. If you're building an individual Canadian dividend stock portfolio, you want to play where it makes most sense. And it doesn't make sense with the banks or Enbridge right now. It might make more sense for something like Canadian Natural Resources, which is actually trading down quite significantly, I believe, and is, starting to rally back a little bit. I mean, it is trading off about 25% from its recent highs. The yield has become more attractive again. So you really want to kind of just look at where the ebb and flow is kind of going in and out of favor, and, take advantage of it when you can. But honestly, at the end of the day, VDY is still going to be my place to go. It's just an easy end-all be-all solution for me to the Canadian markets. So I love it personally, and I'm never going to stop buying it. I actually need to buy more of it, but with these recent upper earnings here, it will be neat to see what the banks can report. But I'll pass the question off to you. I'd love to know what you think about Canadian dividend stocks in that comment section below.